Are you preparing for a financial analyst interview? In this video, we address the top 5 financial analyst interview questions you need to prepare for. But first, please do me a favor. Hit that like button, share this video, and subscribe to our channel for more insightful career content. All right, let's start with the first question. Can you explain the significance of EBITDA in financial analysis? EBITDA, or earnings before interest, taxes, depreciation, and amortization, allows analysts to independently assess a company's operational profitability. But why does EBITDA matter? 2 key reasons. First, its operational focus. EBITDA removes non-operating impacts, revealing the true performance of a company's core business operations. Second, its comparability. By omitting factors like interest, taxes, and non-cash charges, EBITDA enables more precise comparisons between companies, regardless of their financial structures or tax situations. This consistency makes it a favored metric in valuation multiples, like enterprise value to EBITDA, providing a reliable measure of operating performance across different industries. All right, next question. How are the 3 main financial statements connected? Net income connects the 3 financial statements: income statement, balance sheet, and cash flow statement. Although correct, thoroughly exploring this concept is crucial. Let's elaborate. On the income statement, net income flows into the balance sheet's retained earnings. It's important to note that beginning retained earnings plus net income minus dividends equals ending retained earnings. Then, on the cash flow statement, net income starts calculating cash from operations. Depreciation on the income statement is tied to non-current assets on the balance sheet, such as ending property, plant, and equipment, PP&E. It's calculated by adding capital expenditures to the beginning PP&E and subtracting accumulated depreciation. Now that depreciation, a non-cash expense, also appears under operating cash flow in the cash flow statement, linking balance sheet PP&E to cash flow statement investments in PP&E. Additionally, interest and tax expenses are added back to calculate cash flows from operating activities in the income statement. The balance sheet reveals a connection between current assets, such as inventory and trade receivables, and cash flow from operations. Increases in these activities suggest cash usage, prompting a deduction from net income in the operating section of the cash flow statement. Conversely, decreases indicate cash sources, which are added to net income. Similarly, issuing shares or acquiring new debt generates cash for the company, reflected in the financing activities section of the cash flow statement. Conversely, repurchasing shares or repaying debt consumes cash. Additionally, the cash balance from the previous period's balance sheet is the starting point for the current period's cash position. All right, what's next from the interview board? How would you value a company? Explain in detail the DCF framework. Company valuation is a crucial skill for finance interviews, where you'll need to explain methods like discounted cash flow, DCF, comparable company analysis, and precedent transactions. Let's explain each of these. DCF analysis projects a firm's future cash flows and discounts them to present value using an appropriate discount rate. Let's break down the model into its components. Cash flows can be measured in 3 primary ways. The first method involves using free cash flow to the firm, which represents cash available to all investors, including equity and debt holders. The second method estimates cash flows exclusive to equity shareholders. The third method calculates dividends, commonly employed by financial services companies, focusing on shareholder payments. The last 2 methods assess only the company's equity. All right, how do we establish the correct discount rate for valuing dividends or free cash flows to equity? We utilize the cost of equity, calculated via the capital asset pricing model, which combines the risk-free rate and beta with the equity risk premium. Let's further break down the components in the formula. The risk-free rate should match the maturity of the company's cash flows. It typically corresponds to the U.S. Treasury rate for U.S. companies, while a German government bond rate might be used for Eurozone companies. Beta measures the volatility of the company's stock relative to the market. It indicates how sensitive the company's returns are to market movements. High beta values are common in sectors like technology, while low beta is found in stable industries like utilities. The equity risk premium represents the additional return investors demand when investing in equities over risk-free assets. The equity risk premium in the U.S. is generally around 4.5 percentage points above long-term U.S. Treasury rates. This premium, however, can vary significantly depending on the country, with higher premiums often required for emerging markets due to increased risk. All right. When using free cash flow to the firm, the appropriate discount rate is the weighted average cost of capital, which redirects the combined costs of equity and debt according to their proportions in the capital structure. You should also note the importance of the company's expected growth trajectory, typically categorized into 3 patterns. Steady growth involves projecting future cash flows at a constant rate and discounting them to present value for companies expected to grow indefinitely. 2-stage growth applies to companies initially experiencing rapid growth before stabilizing. For this model, compute the NPV value for early high-growth cash flows and add the NPV of sustained growth, terminal value. 3-stage growth suits high-growth tech companies transitioning through rapid, intermediary, and stable phases. Calculate the NPV for each stage and sum it to calculate the total valuation. The terminal value captures all future cash flows beyond the explicit forecast period. It's typically calculated using the Gordon growth model or an exit multiple. Excellent. The other 2 valuation methods in our question are the comparable company analysis and precedent transaction. Comparable company analysis involves finding publicly traded companies similar to the one you're trying to value. You then compare financial metrics such as EBITDA, stock price, and price-to-earnings (PE) ratios. The idea is that comparable companies should have similar valuation multiples. This model is straightforward, quick to apply, and provides a market-based perspective. Precedent transaction analysis, like comparable company analysis, examines past transaction prices of similar companies instead of comparing ratios. All right, next question. Can you explain Porter's 5 forces framework and give an example of a low threat to Walmart? This is a tough question because it requires you to quickly apply a broad strategic framework to a specific company, such as Walmart, without the luxury of time for a thorough analysis. The best way to tackle this question is to briefly explain Porter's 5 forces framework and then focus on identifying Walmart's most obvious low-threat factor. All right, Porter's 5 forces framework identifies 5 fundamental forces that shape the intensity of competition and, ultimately, the profitability of an industry. The first force, threat of new entrants, assesses the ease with which new companies can enter the industry. High entry barriers, like substantial capital needs or strong brand loyalty, reduce this risk. The second factor is the bargaining power of suppliers, which examines their ability to raise prices or lower the quality of goods and services. Fewer suppliers or unique products increase their power. The third factor, the bargaining power of buyers, evaluates how much customers can influence prices and demand better quality or service. Their power is more significant when they buy in large volumes or can easily switch to competitors. The fourth factor is the threat of substitutes, which looks at the availability of alternatives. When substitutes are easily accessible and competitively priced, this threat is higher, potentially reducing industry profitability. Finally, the fifth factor is rivalry among existing competitors, which measures the intensity of competition within the industry. High rivalry, often driven by numerous competitors, can lead to price wars and diminished profitability. So, what is Walmart's most significant low threat? It's the threat of new entrants. Walmart operates on a massive scale with significant cost advantages, strong brand recognition, extensive distribution networks, and a highly efficient supply chain. The barriers to entry in the retail industry are incredibly high, especially at the scale of which Walmart operates. All right, before we wrap up, let's examine the final question you should be ready to encounter in your interview. Which stock has more growth potential? One priced at $5 per share or one at $100? This question challenges your understanding of a stock's growth potential beyond its share price. The appropriate response is, it depends, because a stock's price alone does not indicate its growth prospects. For example, a $5 stock with 500 million shares outstanding has a market cap of $2.5 billion, suggesting it may already be a large cap stock. Conversely, a $100 stock with just 100,000 shares outstanding yields a $10 million market cap, indicating it's very small with significant growth potential. Ultimately, growth potential is determined more by the company's underlying operations, market position, and revenue prospects than by the price per share. We've addressed the 5 key questions you must know how to answer. Please be sure to like this video, subscribe to the channel, and activate notifications. And if you wish to get job ready for a successful career in finance, don't miss the opportunity to subscribe to the 365 Financial Analyst platform. Stay tuned.